Good morning. We will be starting in 2 minutes. We're going to start promptly at exactly 10 o'clock, just to make sure that we don't go into the different activities that we normally do on a Saturday. So we're going to start exactly at 10 o'clock. I think today, as our first session, we may not go the full 3 hours, but that entirely depends on our discussions today. Our focus is the 4 principles of real estate investing. And this is basically an introductory session on real estate, how we should go into real estate, how we should view it, the kind of attitude, personality that we need to be having to be able to carry our strategies forward, how to build our investment strategies, and how to assess investments. So there's many things that we're going to discuss throughout the course of the program. But today, our core thing is to start at the very beginning, the principles of real estate investing. And we will start in exactly 1 minute. Oh, wow. Thank you so much, Tama. So I've just been saying all of these things and you couldn't hear me. I'm very sorry. So that means I'll start at the very beginning. Welcome to our real estate life lessons for our Go Smart Value subscribers. This entire series is really coming from a background of the number of clients that we have who are really at the very beginning of the real estate journey. So we thought we should have these conversations. We're going to make it a little bit lighter, a little bit easier, a little bit casual, so that we can have discussions really and get into some serious learning about real estate investment. So today's class is basically on the 4 principles of real estate investing. So it's basically at the very beginning. That's where we are. We are at the very beginning. We're going to be talking about what are the things to be looking out for, how to set your own targets, how to set your own goals, and just go into a bit of a discussion on where the property market is and what you should be expecting off of it, and how to maneuver around it. I'm also going to share a little bit on some podcasts, some books that you can read, some podcasts that you can listen to, just so that you can improve your real estate knowledge as we go through this journey. The whole idea is for you to understand more about particularly the Botswana market, but a lot about real estate investment, so that you can be able to grow your portfolio, you can be able to build up your portfolio. But thank you so much for joining me this morning. So essentially, in terms of housekeeping, to ask questions, you can just put them on the Q&A. I'll be able to answer them, the ones that are relevant. You can also request to speak. Just put your hand up, and I will be able to allow you to ask your question or speak. Today is more, it's not a presentation as such. There are some slides that I will put up just for visual purposes, but it is more than anything about a discussion on real estate principles and also how we are able to move on. So the first thing about real estate, just like any other investment, is that you need, there are just these core principles that make it work. And these are no different from any other type of investment. It's the application of them that makes them very, very different, or make them a little different. So the 4 principles, let me just share this the screen here. Okay, so the 4 principles of real estate investing, it's just these 4 things, right? You have to have goals. You have to have goals. The reason why anybody goes into investment is because you want to achieve something. So consider what you're trying to accomplish financially within a certain span of time. And it is very, very important that you have thought through this entire process. You've thought through what you want to achieve with these goals. You've thought through what it means to you. So we're going to go through what is called the 10x model for you to have an idea of how to set your real estate goals and what are the key things that you should be thinking about when you set those particular goals. So in terms of costs, which is the other thing that you have to consider and think about, costs, consider what property investment is going to cost you, right? And this is not just about how much investment you are going to make or how much money you're going to part with. It's also how much sacrifice you're going to make. What are the opportunity costs that you're going to have to incur to make sure that you are able to achieve the goal that you're looking at particularly achieving. Now, actually, before I go into that, the other key thing is balance. You need to make sure that you balance your risk with different and diversified investments to ensure optimal performance. And in this case, just to give an example, we should be thinking about when we go into property investment, how we choose different types of asset classes and different types of risks. So when we talk about the different types of asset classes, we talk about, you can be talking about residential, hoteling or tourism, commercial, retail, what am I leaving out? And industrial. So when you are thinking about a long-term property investment, first thing is you think about which sectors you are interested in, right? So you can balance your portfolio by having different portions of different sectors, right? Another way of balancing your portfolio is for you to have investment in different locations, because locations generally don't perform the same way. So you can choose, I'm only going to invest in residential property, but you should know that you choose locations that generally do not flow the same way, or generally are not affected by the same economic factors. And that way it makes it a lot easier for you to grow your portfolio, because when the other side is not doing well, the other side starts doing well. And the key thing about going into property investment, one key principle is discipline. And this is the one thing that we find that a lot of people who get into, especially our clients who are starting on this property investment journey, that is the one thing that oftentimes trips over. Real estate is not a simple, easy investment to get into. Otherwise, everybody would be in it. But if you really want to benefit from real estate investing, you really need to have a lot of discipline. It takes everything takes time, whether it is development, it is purchasing, it is finding the right deal. Everything generally takes a lot of time. So you need to be determined to achieve your long-term plan. You need to be determined to work really, really hard to stay within your target. So before we go into how you apply these principles into your life, let's look at the property market and how we can be able to predict what is happening in the market, what are the signs, what are the indicators that can help us to understand what is happening in the property market without making too many assumptions. So generally, these are the core indicators of the property market, right? So if one would guess where we are in the property market, looking at the small indicators, so we would say the first quarter, the slowdown, the first quarter of the sellers market, you would find that there's low rental yields. There's an affordability crisis. That means less and less people are affording, or every time you try to buy a property, there's an issue around affordability driven mostly by the financial institutions. There is stock oversupply, is speaking of when there is a lot of properties in the market. If you're buying and there's a lot of properties that are being there in the market, then it's starting, the slowdown is starting, right? And then you find that construction prices are falling. That is a slowdown. That is the time of the slowdown of a seller's market, right? And then we go into what is defined as a slump. So a slump, we would have what is called abundance of tradespeople. So you find that almost everybody is an estate agent. Everybody you meet, every second person is selling a house. Every second person is doing something that has to do with real estate. That we are approaching a slump in that regard. You start seeing property valuations fall. You start seeing more sellers than buyers. You start seeing a bit of a drop in confidence in the market. I think some of these things you can start relating to in terms of where we are in the market. And then recovery is generally, you start seeing these indicators. Rentals start picking up, stock levels start tightening. That means there's less and less properties that are available in the market for purchasing. And then when there's less and less properties that are in the market for purchasing, that means demand starts matching the supply, and then prices start picking up. With that, then we go into the next quarter, which would be the rise in property valuations. That's because the prices have started rising. We start seeing more comparables of prices that are up. And then there's less and less people who are trading in real estate in that regard, because a lot of people have been kicked out by the slump. It didn't look so good, so they start moving out, and then the ones who remained would still be there. So that's how you have a shortage. And then you start seeing a greater media hype where people are looking for buying more properties, and that's the seller's market. So generally, these are the overarching indicators of the real estate market. So if we could just, I don't know if we can have a discussion, just let me see if I can allow us to have a conversation around this, where I'm just going to switch on everybody's mic. Then you can be able to speak. What are you experiencing in the market, and where do you believe the property market is? And let me just put this graph up so that we can talk about it and remind ourselves of what exactly we are talking about. So when you talk about the Botswana market, no matter which, right now, because we are in the same economy, we are generally affected by the same thing. We have the impact of fuel prices is the same in Gaborone as it is in Francistown, as it is in Maung. We've just come out of COVID. So when you think about the experience of life right now, is there anybody who wants to share where they think the property market currently is? I think everybody's mic is on. Anyone can speak, please.
Hi, Latoya here.
Hi, Latoya.
I'm quite confused. The Botswana market is very odd because what I know is right now we are struggling to buy groceries, we're struggling to fuel our cars. But when you look at the adverts of property on Facebook, wherever, it's really still ridiculous prices. It doesn't look like there's a slowdown at all. Yeah, no, I don't. That also confuses me because then if we don't have money for food, where are we getting money for property?
Yeah.
So
Okay.
So maybe we're right in the middle of boom and slowdown, like right in the middle. I don't know.
Let me just explain how you assess that, right? So when you think about the time when financially households were not yet struggling per se, would you say there was a lot of properties for sale? Never mind the prices, but the quantity of properties in the market.
I think there was a lot. Now that you say it, what I've realized is that there are more bank auctioned properties available now, which was not the case before COVID. That is what I've noticed.
Okay. So essentially, I don't know if there's anybody else who wants to comment on that, what they think, where they think we are in the market. Ona, you've been looking at a lot of properties most recently. Please share with the other members.
Okay. Good morning, everyone. My name is One Matangwani. I'm a mentee in the Go Smart Value program by Mamanaki. So my view on where we are is that I've seen that valuations are going down. I've been checking some properties for some time. You'd see it from 1,050,000 at this point. One that I've been looking at is now at 930,000. It's been in the market for over six or so months. And then we are seeing that rentals, people are shy of renting, above a certain threshold. So there is some sort of a correction that is happening in the inflated prices, both in rents and in property prices. So we are generally in what I believe is a buyer's market, and you are able to negotiate quite significantly at this point. So I would say we are between recovery and slump in my thinking.
Okay.
Yeah.
Latoya, do you have a view on what he just said? Are you relating with any of the things he said with regards to the confusion that you had before?
Yes, now I hear him. I understand what he's saying. But as to that, where we might be between slump and recovery, that would then mean that we're already almost at the end of the slump and beginning recovery. Isn't that a bit too forward? That would mean you're already preparing to recover and have the prices go up. And that would be problematic.
If we're in the middle, that is what it would mean. But generally, in my experience, particularly in the Botswana market, each of these quarters take about 10 years. So the slump would start very, very slowly, and then it goes. And by the time when it gets to the end of the slump, everybody's sort of like, hey, property is not performing type of thing. That's when you start moving. When you still have people who are hopeful, who are selling their properties with the confidence that Latoya was talking about, putting them at these wishful prices online. We're still in the very beginning. Not a lot of sellers still haven't accepted that they will not be able to achieve that price. A lot of buyers in Botswana, this is the one culture that generally we don't have, that is negotiating. So it takes a little bit longer for the slump to really hit, because people are not negotiating prices. And most of the times, deals are stopped by the bank saying, I will not finance this. Not necessarily because the buyer is saying, no, this is not worth it for me. And that is the one thing that we need to learn at the current time, that where the market is right now, every price will start at the very top. It will start at your 1.5 million. It will start at 2.8 million. If you really want that property, and I will show you the different tools that you should be using. If you really want that property, just assess at what level is it going to be viable for you to purchase it. And the viability is about its ability to give you rental that gives you a positive cash flow. That's what makes it viable. Not that it's in a nice location or that it's got potential for development or anything. The only thing that makes a property viable is that it gives you a positive cash flow, right? So once it gives you that positive cash flow, then you negotiate. You put in your offer. Never be shy to put in an offer. Put in your offer at whatever the price is, even if they've put it at 2.8 million and you believe it should be going at 1.5, put in the offer at 1.5 million. Because what you're doing is pegging such that once every other offer has been rejected, because they might get offers that are less than 1.5 million, or they might not get any offers for the next 9 months, and you are the only offer that is there, there's a greater chance that you'll be able to achieve to get that property for the price that you particularly want. So now that we have established, so just to close this for everyone, where we are now, we are still very much in a buyer's market. We are still very much at the beginning of a slump. So the challenge that we have had as Botswana, and this is something that is also experienced by other countries, but our recovery level differs from one country to another, is that we started our slump just before COVID, right? So from 2018, we were starting to see more and more banks start their repossession process. So we had already started picking up that, oh, a slump is coming up. And that's one of the indicators. I don't know why it's not on this chart. It's one of the big indicators where you have got a lot of defaults of mortgages. And then COVID came. When COVID came, even those who would have survived the repossession then fell in. So then we have a big pool of property that is coming into the market on auction, and also or where people are looking at their finances and saying, listen, we cannot sustain this property. What also started happening is every household or households were starting to get obviously a lot of pressure on their pockets and reconsidering maintenance of assets that are not making sense, right? So we come from a history of people who buy property. I mean, this is across the continent. People buy property for pride. People buy property because it will be great for our kids in the future. There's all of those. When the property is looking to eat from your pocket, when your pocket becomes tight, it is the first thing you want to let go of. So we also have that group of people who are saying, listen, we can't afford to keep this. Let's let it go. There's also, remember, the amount of deaths that we got from COVID and the amount of estates that are being closed from that period that have got property in them. Some are choosing to sell, some are choosing to dispose of them, and all of that kind of stuff. That adds on to the stock that is particularly in the market. Real estate, unfortunately, as what is it? Sometimes it becomes cruel in how it views economic situations or financial situations or activities that happen in the economy. But at the end of the day, the impact of what has happened is that a lot of stock has come into the market, and that is what is making a lot of transaction, a lot of prices start falling, or a lot of prices are falling. So they're already falling, but a bit slowly. Now they are falling even further. Now the challenge is that the cost of construction has been challenged by COVID, right? Where we had a shortage of steel, cement, and also the Russian war. So all of these come into play, and I think now we have seen that there's been a significant reduction in properties that are being built for sale immediately, because the cost of building is doesn't get you don't recover it from selling because prices are beginning to drop. So that's sort of that thing is sort of balancing out. And then what is also happening in the pocket of the household is affordability itself. So remember, at the slowdown of, there was already an affordability crisis before. Now affordability is even much more tighter because of other aspects that are not particularly from real estate, right? Affordability is reduced because there's fuel, because of households have lost income. We are still having retrenchments in the country. There's retrenchments globally. So everybody is cautious of, where do I put my money for a long period of time? Do I really want to put my money inside property? How much can I put in there? So if you have an option, you would rather put less so that you still have some that you keep to yourself. So all in all, we are currently in the slump. I personally believe we are still in the beginning of the slump, because right now a lot of people who have owned property for a long time are only starting to see their valuations stay stable. So if somebody did their valuation in 2020 and they're doing their valuation now, it may have just stayed at a plateau, or it has dropped slightly, not significantly as yet. So we haven't seen a significant fall in the valuations, but we are definitely seeing a big fall in the prices, 30%, 40% plus. That's really happening. If you're watching the market, not just at sale. So if you choose a property and you track it over a period of time, you will see that the next time it comes onto the market, its price has dropped. The next time it comes into the market, the price has dropped even further. So if you're really looking to buy that, just put your offer in, and at the right time, the seller is likely to give you a call and say, okay, fine, are you serious? Are you still interested in purchasing? I'm willing to sell it to you at this price. But make sure that your rental levels are at a point where you will be able to generate revenue from that property. It gives you a positive cash flow, right? So that's generally how we view the market when we talk about strategizing on how you do your purchasing, when you do your purchasing, and all of that. So at each point of these quarters, you as an investor, you can invest at any point, right? But you should know when to invest in what and what to do with your investment at each stage. Where the market is in right now, it's not the time to build anything. It's the time to buy, because the cost of construction is higher. So if you are going to build, the chances of you getting sufficient income for you to get your money back that you've invested in construction is very, very low. It is better in this current circumstance for you to buy a property that you can immediately tell how much rental you can get and make your investment make sense from the get-go, as opposed to for it to be for you to predict and try and figure out if it's going to work out in 2 years or in 3 years time. So if you're looking at setting your goals, in the short term, you should be looking at properties that you're going to buy as opposed to going into construction. The other aspect about investing in property during this time is, like I said before just now, patience. You need to be patient. You shouldn't be in a rush to close any transaction because you might just miss out on a good deal just after. So just do it with ease, do it understanding, okay, fine, this thing could work out, but make sure that whatever transaction that you close, it is to your particular advantage, right? Okay, so in terms of us setting our goals, so let's do this. This is an exercise that you can do on your own, so think about it. So this is just an example of how you can set your own goals. Nobody goes into property for the sake of going into property. You're looking at something, right? You are looking at your life, you're looking at your lifestyle, you're looking at all the other things that as a human being, they are part of your life. You encompass all of them. So you need to make sure that real estate is not a separate aspect of your life. It is part of all the other things that you're doing. So in terms of your estate planning, in terms of like when you're drawing up your wills, your plans, your lifestyle and all of that, it must be part of that plan. It's not a separate thing that we are doing on the side. It's not a thing on the side. It is part of what you are choosing to build wealth with. Generally, when somebody comes into to us, at least to as a member of Goals to Add Value, the whole idea is I want to build wealth, right? And you want to build wealth, you want passive income. But it is important for you to know, why do you want to build wealth? And what does wealth mean to you? Is it about carrying cash around? Is it about some kind of lifestyle that you want to lead? What is it really about? So this is sort of a template that I personally use in terms of setting my goals. So you can start off with, there's different aspects. So you can have different items in there. You can have your body, you can have your lifestyle, you can have your relationships, you can have your finances, you can have, so you put them all in there to make sure that you cover each aspect of them and they all gel together in terms of where you want to live your life. So when it comes to building wealth is not a single day activity. It is consistent activities that you do on a daily basis. So everything that you do should be about building wealth if your intention is to build wealth. The reason why I spoke earlier that we're going to go through, I'm going to recommend some podcasts, I'm going to recommend some books for us to read, is because we really need to change our mindset to prepare ourselves to invest in property, to prepare ourselves for the challenges that require, that we will face when we invest in property, and how to build the attitude that is needed to actually build wealth, to actually grow wealth. So one of the key things that I think sometimes people want to go into real estate to do, one would say, I want to get financial freedom, but their path to financial freedom is I'm going to buy a house and sell it. And I always say that's trading. You're trading. You're just as much as somebody who buys shoes and sells them. You make a profit, and then you do what you do with it. That's not building wealth. So generally, building wealth is about building something that is sustainable. It's about accumulation. It's about continuously building something on top of it. That's why it's called building. You start at zero and then you keep on adding. So when we set our goals, make sure that you encompass everything about your life and you see them all coming together. If you have a question, please feel free to ask so that we are moving together and we don't end up with going on to the other aspects without covering this one. So I recommend that before we go on to, by next month, you should have this very clear for yourself. What are the items in your life that you want to work on? So one would be, like I said here, you can put body, you can put lifestyle, you can put finances, you can just put all of those things that are different aspects of your life. When you go here on current, what's happening right now. So I would say here, I want to work on my financial freedom. Currently, I am fully reliant on work. So I'm fully reliant on my salary. What is my goal? I want to retire. What do I need to change? I need to start a business. And what is the whole thing about starting a business? And this is the very reason why you need to know the purpose of everything that you're doing. The reason why I'm starting a business is for me to have additional income. So what does success looks like is for me to have equal passive income outside of work. What does it mean? So the reason why we have to think about these things fully is that if I'm going to start a business, then the type of business I'm going to choose is a type that is going to give me passive income. It's not the kind that will stop me from retiring, because my goal is to retire, right? So when I look at what kind of things I want to get into, this is just in line with this. If I look at the things that I want to get into, I'm only going to look at things that will align with my goal and will get me to where, to the image of how success looks like for me, when I talk about my goal of, or my item of financial freedom. So really think about those, and before the next class, which is next month, let's have that in detail. Let's explore that. Let's fully understand what is motivating us to build wealth in that regard. Is that a question?
Yes, I have a question. It's actually in the Q&A.
Sorry.
I just wanted to ask. Earlier you mentioned that property, the point that we're in the cycle, property prices are dropping as per observation, and I wanted to know how long, on average, from your observation, you would say it stays on the market before it finally gets a buyer.
Okay. We have seen, because it's not an exact science, hey? So if a property is significantly overpriced, it can be in the market for 2 years. So it's really about how quickly the seller is willing to sell. Sometimes they get off the market, not because they're sold, but because the seller decided that, no, looking at the offers that we are getting right now, it's not the right time for me to be selling. I'm not selling anymore. So they do stay for quite a long time. 3 months is a very short time for anybody to think of selling a property and getting a buyer. It's a very, very short time. So on average, it's 9 to 12 months for a property to be sold. And they go even as long as 2 years to be sold.
All right, thank you.
Thank you. Is there any other question anywhere? That's why it's very, very important for you to be, what is it called? To be patient with yourself. Or with achieving those particular goals. So setting your goals, or setting your goals, you need to have a target, fully understand your target. So before I go into that, let me just give you, let's see. Okay, that's there. So when we talk about targets when it comes to property, there are different ways that you can measure your investments targets, or property investment goals, right? When it's only about property, you can choose a value that you are looking for, and this adds to your, because I grew a building wealth, it builds to your net worth, right? So you say, okay, maybe I want to have a net worth of 10 million, and I wanted to compose of, I get we are building our entire wealth, our dream wealth portfolio. So you say, I want my net worth to be 10 million. I only want 5 million to be coming out of property, right? And that means if it's net, it means it is net of your loans. It's not just the value of your property, it's net of your loans, right? So that means you need to be looking at, okay, fine, where am I now? Remember, where am I now? What is current? Where I want to be is 10 million. And what do I need to do now to get there? And that doesn't mean that if you're building towards a value, a portfolio value, 10 million, then you are now looking for a 10 million property. No. It means between now and 5 years time when you achieve this, or 10 years time when you achieve this, you can be looking for 600,000, 750,000, 400,000, and all of that. Remember, with property, the benefit that you also get is they grow in value themselves, right? So, and the very key thing why when you buy them in a slump, they must be worth what they're worth, is that if you're buying them at a ballooned value, you'll be highly hit when the market goes down. But if you're buying them at what their income value is, the chances of them dropping below that is low, because your rental is not determined by any other factor. This is the rental that your property is really able to achieve. It is an affordable rental. It is the real market rental. So oftentimes people, we miss it, yeah? When we buy property, we then put in our hearts, our feelings. My house has a beautiful garden. I've put in quartz kitchen tops and marble tiles and all of that. When the market is doing what it's doing now, buyers don't care about all of those things. It's a kitchen. It's a kitchen counter. They're not going to pay more because you bought a quartz counter or your tiles are marble, or that you imported your plants from where. And that's really where a lot of times people get highly disappointed by what is happening in the market. Sometimes people like now would be wanting to sell their property, and before they put it in the market, they then go and buy, maybe build a gazebo or an entertainment area or a garage, with the belief that that is going to add value. And just to give you context, the value of a property is how much buyers are willing to buy it at right now. So anytime a property valuation is done, that's really what valuers are looking for. It's how much are people willing to pay for this property if it was sold in the market today, right? And some of the improvements that we make on our property are not enough, especially when the time is wrong, like now. It's not enough for people to say, okay, fine, I'm willing to pay for that. Not at all. Oftentimes people are not willing to pay for that which you believe is worth paying for in that regard. Okay. So where were we? Let me just go back here. Okay. So we were here at your target. So you can choose value as a target. You can choose an income level as your target. I think an income level is the most important target because that's really what hits your pocket. That's really what makes a difference in how you live your life. A value target is you can only extract that value when you sell that property. Otherwise, it is great to have it in your balance sheet. It's nice to have when you're discussing deals and all of that. But an income target is the one that makes a difference in your actual day-to-day life. So have an income target. I would recommend that you have an income target. So these are the two targets that you can have. The third target that you have is a return target. And this one is where sometimes people miss it. Your money is worth something even when it's in your pocket. As long as it's in your possession, it's worth something, right? It can make you benefit something. So your starting point when you think of returns, you must start with the long bond rate, the risk-free rate, the government bond, right? The government bond, I think now is at 8% or around there. And that is the 10-year long bond rate. The reason why you start with the long bond rate is because you will be paid back depending on the government, but ours does. If you put your money in there for 10 years, you will get the guaranteed return and the guaranteed growth. So it has got no risk, right? So if you want to make a clean return that has got no stress, no risk, no additional investment, no what, you put your money in the long bond rate, in the long bond, right? So any investment that you make that gives you higher risk levels, higher stress levels, more possibilities of putting in more money, and all of those other dynamics that the long bond rate does, that the long bond doesn't give you, you must charge a premium when you put your money in it. Are we together?
Yes.
In that regard.
No, we're good.
Okay, great. So when you're looking at, so when you are assessing property for investment, for instance, different property sectors, different locations have different risk levels. And the risk level is really about what is the chances of default, right? What is the chances of your tenant not being able to pay ever? Right? So default is they're not able to pay now, they'll pay in arrears and whatever. And then there is what are the chances that they will die or the company will close or that kind of stuff, and you will not be able to get your money out of it. So those are the things that when you compare one asset class and another, they have to come into play. And then the other one is when this tenant leaves, how fast can I get a new tenant, right? So for instance, residential is of a lower risk than obviously hotel. Hotel is very, very high risk, right? And then followed by residential would be and I will explain why hotel is very, very high risk. So it would be residential, and then current situation, offices are not really, really good for different reasons. Because now a lot of companies are reducing their office space, so it's not a good area to get into right now. There isn't a lot of expansion in a lot of businesses, so I wouldn't advise anybody to get into offices right now. But if you get into it, so with residential, if you get into it, you will have multiple tenants. So your risk is a bit managed there, and even the amount of rental that you are getting, they're smaller in proportion. Your risk in residential can be increased by it can be increased or reduced by having a tenant that takes up, say you've got 5 units, and then a company comes to you and says, no, I want you to accommodate my staff, I'm going to take all of the units, right? That's a great situation, but there's a risk. The day that company decides we're no longer paying rental for our staff and they terminate the lease, you lose all of your tenants at once, as opposed to losing one at a time. So those are the things that you need to think about when you're closing your leases or when you're negotiating all of that. It always sounds good when somebody says, no, but the multi whatever company. I know it happened a lot where companies that are contracted go the mining, would then occupy all of that. But once they finish their contract, everybody leaves. And then you have to look for new tenants. You're used to the high rental that they were paying as a premium because for them it was also a benefit for their staff. And now the benefit that you're getting from your property then drops. So those are things that you need to think about. For office, there is what is called, and this applies to all the commercial properties. Most tenants require beneficial occupation beforehand, and beneficial occupation is a period where they occupy that property to allow them to make it fit their branding. Sometimes a month, sometimes 2 weeks, sometimes 3 months, depending on the size of the property and the brand that we're talking about. And during that time, you're not getting any rental. It's beneficial for them to occupy that space. So you need to be careful when you get into these areas so that you know how really that particular sector operates. When it comes to industrial, same thing. They're often very difficult to replace because what they're manufacturing may not be compatible with what the next person wants to. Distribution also, distribution, depending on whatever it is that they're distributing, can the next person occupy that particular space? So those are things that you need to think about when you choose which tenants, which sector, which property type you're going to choose. But in terms of performance, I'll tell you here above off the bat, industrial performs better, and then it's followed by it's industrial, residential, retail, office, and tourism. That's the order in which they're performing right now, right? Now, so that's with regards to your targets. And just before I go into planning, let me just explain why I said earlier that tourism is risky. Oftentimes, what I have seen is people, when they say they want to own a hotel or a property, they want to invest in a hotel, they mean them as an owner operator. And as a business, that generally doesn't work. The main hotel operators don't own the properties that they operate in. Why? Because the hoteling business on its own is very capital intensive. And when you now add the building onto it, you are now adding an additional thing that does not increase the performance of your actual business, which is the hotel. So oftentimes they do, so each hotel would have an operator. I think just to give a typical example, we have seen Komasa when there was Masa Hotel, and then there was Lansmore. Lansmore was an operator that came in and left. And now we've got Protea was an operator. Masa initially was operated by the owners of the building. And that was because they had, just to understand, they had a contract with another operator that fell through. And because they had already put in the effort of making it suitable for a hotel operation, they then had to run the hotel for some time until they found the next operator, right? Most of the Crestas are not owned by Cresta the hotel. Cresta is an operator. It's leasing them. So when you invest in hotel property, you are the owner of the property, and there's a hotelier that is operating that, and they pay you rental. Your job is to ensure that the property is in a good state for them, and you agree on, in terms of your lease responsibilities, you agree on what is your responsibility and what is their responsibility, because some things have to be kept to a certain standard to meet their requirement, as opposed to keeping the property just barely occupiable, right? So those are things that when you're thinking of your targets and the sectors and all of that, make sure you fully understand the sector that you want to get into, and you fully understand what kind of commitment it would require of you and how that operates. There's a hand up, Defo.
Good morning.
Morning.
I think I missed the part where, in terms of, you were talking about how the different sectors are performing. I think I got industrial. Just to maybe reiterate that point again.
Okay, so the top one is this is always a moving thing. It's not permanent. Don't come back 2 years later and say you said industrial is performing better. That's why it's important for you to stay up to date. So the top one right now is industrial, followed by residential, followed by retail, and then office and hotel.
All right. No, thank you. Yeah. Thank you.
Thank you. So industrial, so I'm just going to talk about each one a little briefly, just so that I give the equal, for you to have equal information about them. So hotels, we know they're operated by, and this speaks to, there's hotels, filling stations, all of these, they have an operating modus operandi. So you should know, how does this sector really operate? How do people make money in this area when they own property? We often assume, no, if I own a filling station, ke run a filling station, ke run the kiosk, ke run a thing, and then you you are not running the property. You're not the owner of the property. If it doesn't work out, you lose everything. But when it comes to property, so you have increased the risk of your property not performing because you are everywhere in it. For you to build wealth with property, it really has to be passive. And passive means you are not the operator of the business that is occupying the property. Right? So industrial usually has got 3 types of leases that are available. There's what we call a triple net lease. A triple net, as in a net that covers everything. A triple net lease means that the tenant takes care of everything. Maintenance, any kind of maintenance, any kind of repairs, anything that they need for the period of time. And normally those leases are 10 years. They take a long 10-year lease. It's a triple net lease. You get your rental. And in terms of negotiating those rentals, sometimes the base rental becomes low, and then you add a turnover clause, or you have your escalation. So those are different ways in which you can, in which we play with the lease terms in order for you to be able to generate revenue in a growing way. Residential, I think a lot of people now know how residential works. You are Hirisa, you pay rental. The risk that sometimes people put in their leases, or sometimes just, guys, never put anybody in your property without a lease agreement. Your lease agreement needs to have how much rental are they paying? When should they have paid it by? What happens when there are things that are consumable, or that can be disengage usage? These are switches, door handles, toilets, those kinds of things. Those are supposed to be the responsibility of the tenant to fix them, because disengage how they use them, right? The landlord's responsibility should be more on structural issues, right? Structural meaning there's a crack, there's a roof leak, there is like big things. Those are things that are supposed to be the responsibility of the landlord. And then the other things are supposed to be the responsibility of the tenant. Remove utilities from you as the landlord. Utilities, all of them. Motakaseli should be things that are paid for by the tenant. The security, you can install security, but they should subscribe to security. And I've seen sometimes where, even because I love my jarateki hirisitting, I then also have a gardener who goes and makes sure and all of that. If your tenant is not paying for that extra service, is not paying you a levy for that extra service, you are wasting money because there is no value you are deriving from that. Apart from that, your house is beautiful. That's all. And we need to differentiate. When it's an investment, it's not about beauty and aesthetics and all of that. It's about money. It needs to be clear that it's about money. So that's residential. Retail. The retail scale. Let me just stop sharing so that we can see me. The retail scale goes like this. The bigger the tenants, the lower the rental they pay. And if you've built if it's a single shop, right? Then you will have one tenant, and that's really it basically. And you provide them with provider with what we call a gray box. A gray box means cement, and you don't have ceilings, right? And then a white box, and this applies also to commercial. A white box means you have tiled, you have finished the floor, the ceiling. That's a white box. And then fully fitted means that you finish the property according to the requirements of the particular tenant. The provision here, the fridge, the provision here, the office, the provision on all of those things. These are not necessary. Every single lease, you agree with your tenant when you go into retail, when you go into office, you agree with your tenant. This is how far I go. This is how far you go, and those are the things that sort of determine what kind of rental you will get out of that particular property. Retail also, because generally when a shop is unselling, you don't get a lot of foot traffic at the beginning. Oftentimes you'll have the shops negotiate where a rental should be kept at a certain level for a certain period of time. Sometimes it can be fixed for a certain period of time, and then it's picked up or reviewed at a certain period of time. Or it can be a low base rental with a turnover clause. So a turnover clause usually says the tenant will pay you 1% of that turnover plus the base rent, or it would say you'll pay me 1% of your turnover, or this amount of rental, or whichever is higher or whichever is lower. So those are things that are flexible when it comes to retail property. You always have, like retail and offices, you have to make a provision for levies, for common areas. At least now you can have every unit can have its own meter, so that's fine. But when it comes to the common areas, the passage, the lift, the ding, you have to make a provision for people to pay pro rata towards covering those expenses. So now I think with this, you start to see where the benefit of real estate is, because as a landlord, you really should just be making a profit, because you are providing accommodation for people to do business or for people to benefit from it. So it should only benefit you. Anything that you invest in that doesn't benefit you is not worth investing in. I'll give you an example. In the years when load shedding, load shedding, not now the South African one. I don't remember, it was 2007 or 8, somewhere there. There was a whole rush where tenants were asking landlords to put in generators. And some landlords did and added it to the rental. And some landlords were clear, if you want a generator, put it in yourself. Because if you're not prepared, because the generator is not just the generator, the machinery. There's also the maintenance of it, the servicing of it, and then there is putting diesel in it. So for a landlord who is savvy, they would say, okay, how much does this thing cost me to maintain on a monthly basis? Okay, it cost me 5,000 pula. Okay, the tenant did it, that means you have to pay me 500 pula a month to the generator. Plus a little bit of a premium because I'm going to part with the 20,000 generator for you guys. So those are the real conversations that landlords have with tenants when it comes to inconvenience. Instead of us saying, oh, my tenants are suffering, I need to get them a generator, the extra renter. The extra, you don't buy the generator. And it has to be that straightforward. And just to bring it home, when it comes to when you own a multi-res and you want to own a multi-res and what you're thinking about is no, I need to put in a nice stove and all of these things. If your tenants are not going to pay you an extra buck for those things, don't put them in. You're not the one who's benefiting from them. Don't put them in. So those are the things that you really have. You need to be that crisp in terms of your income and your expenses in that regard. How work our hair, cleaner, your tenants must pay for that cleaner. Otherwise, they should be doing the cleaning themselves. So those are things that you need to think about. Office and retail are not too far different. Leases are generally signed in advance, and the negotiation is generally the same between office and retail. With office, you hardly ever have a turnover clause because generally the businesses are not high trading. So you'd have your whatever your rental is, and then you have your escalations, your levies, double parking, and all of that kind of stuff. One other thing that I forgot to mention, retail. I said the anchor tenant, the big tenants, your Game, Checkers, Choppies, Spar, ShopRite. These are Pick n Pay, Woolies. These are usually the anchor tenants in a shopping mall, right? And as they are the anchor tenants, they take up more than 1,000 square meters of space. Sometimes they take up to 3,000 square meters, depending on how big the mall is. And they pay the lowest rental because they are the foot traffic drivers. They are the ones that will tell you whether your mall will work or not. How about now, and these are not there or any of their brand. Like you know that Choppies has got multiple brands, ShopRite has got multiple brands, Pick n Pay has got multiple brands. If they will not give you anything, just know that that thing is not going to work. That's why when we talk about your feasibility, make sure that you secure your main tenant first to make sure that your property is going to work. So they pay the cheapest. The smallest shops pay the highest because their contribution to the mall's foot traffic, it got us. So you will have your big shops. We have what we call utility spaces. So places where it doesn't matter where it is in the mall, people will go there because they have to. Banking halls, where you have water utilities, BPC weighing, they are generally given spaces where people will still go to them anyway. Somebody who banks go Stan Chat, they will still go to where Stan Chat is. It doesn't matter how he can. The people who need to be near the front of the shop, and this is speaking about tenancy mix. So when you talk about a shopping mall, the thing that makes it work is what is called a tenancy mix. So tenancy mix, okay, fine. Who do we put where? The small. So you see how level Riverwalk, Obo level Airport Junction, Obo level Bo Nzana doesn't have depth. Galo does. So you find that the shop to come inside. Eateries, what, they are put somewhere in the center so that people can walk towards them inside. And then house space, yes, they can be put in the front. But the reason why they are in the center is that when you are walking, then you are able to, as a buyer, you are able to go into other shops. So there is a mechanics to making a shopping mall work profitably. I've spoken about hotels, so now we can move on to the next thing. Papa. We're still go target. So planning. Real estate is a long game. No quick fixes, no quick wins. Every step you take must add to your goal. So this means after you have set what your target is, you never buy a property and say, hey, I think it's a good opportunity, but if it isn't the portfolio in your own. Anytime you put a bad property in your portfolio, it affects the entire performance of a portfolio, right? It's like if you want to have pure water and then you add a drop of ink, it affects everything. So singwa has to be in line with what your goals are in your portfolio, right? So when we build, yes, John? John, your hand is up. You can speak. Or is it up or by mistake? Nkongi?
Good morning.
Morning.
Just out of interest, you were talking about the different retails in the retail space. So I've noticed that Go Airport Junction, Nando's has moved from the in-house. They did the drive-through. When it's like that, you as the owner of the property, what are the negotiations or how do they look like?
Okay, so in that scenario, have they moved out completely? Because I thought they're both inside and out. Like they
moved out. Okay. They moved out completely. Yeah.
Okay. So what usually happens is Nando's would say, hey, I need more space. And then the landlord will say, okay, we're doing a renovation, because that's literally what happened with that project. We're doing a renovation. Should we extend your shop? And then say, no, we're actually changing, because with Nando's, they changed their business model. We need space for, we want to do a drive-through. They were not, okay, if you want to do a drive-through, I have got this number of parking bays, but I need to replace the rental. Yeah, okay, no shapo. And then they agree on costs. So what would happen is Nando's normally has, it's even for their shops inside, they have got designs. It looks like this, it sits here, it does like this is the material, this is the what, they give that to the landlord. The landlord then builds that. Sometimes the tenant has got, a major tenant like that, they have got their suppliers, and they pay rent just like they're inside the shop. But they pay rent not just for the space that they are occupying, they pay rent for all of the parking area is around them, is designated for them. Nobody can drive through that drive-through as I gonna lose. So they pay for that space also. They pay rent full. Inside. So it's sort of increasing the lettable space, that particular mall. It would be a normal lease. It would be a normal lease, because those things need to be brought to that space. Metli has to be brought there, Motakasi has to be brought there, and all of that kind of stuff. It's all part of the bill. It's a normal lease. The lease would have to be long term, so they wouldn't do that over a 5-year lease. They will do that on a 10-year lease. because then the money, the investment is recovered, and also the rental is worthwhile. So it would be over a 10-year lease. Are we good? I saw that there were 2 hands. Okay, there's a question, a new question here. Please share the current typical returns per sector. Okay, let me see if I have that here. The year just began, so this would be the 2022 returns. So there they are. You have industrial there. Retail has dropped a little bit. So this is from last year. So these two have dropped, and then this has come up. We don't have hotel here because it doesn't compare in terms of the rental arrangements that are there. We don't have it here. Are we good? So you'll have, we're getting industrial. Kumpiano actually is doing more than 9%. You are getting about 12% there on industrial. We're seeing residential edging up to go 8% there. And then office 6%. And then retail is stable, about 7-8%.
Yeah, sorry, I think you meant to share.
Oh, I didn't share that. Sorry. I thought we were watching it together. This one. There we go. Yeah, these are from last year. Like I said, industrial has moved up a little bit. The industrial is having it's having a good time in not the old industrial, the new industrial. So the new industrial, there's a big demand for distribution centers along 2 routes, along the road to Kazungula and along the Kalahari route. So all of the companies that are considering any kind of online possibility are now looking for distribution centers. And you would see, I think I've seen an increase in distribution centers I've seen them go Letlhakane 1 or 2. Coca-Cola is looking for distribution centers. They're paying a premium for that. Kaha, because essentially what the logistics companies are trying to curb, and this is post-COVID, is a situation where another pandemic comes and then they lose their profits to people being kept at the border. So those are the things that people are trying to avoid with industrial. That's the in of why industrial is in high demand. The workshop ding. It's nothing has changed. Nothing has really affected them that much. Are we all right? Okay, let's go back. Hey, there's another hand. I can't tell who it is right now.
Yeah, I'm just looking at the residential property yield. It's around that 6%, and currently the rates that you are getting, loan rates that you are getting, are quite
Hi.
significantly above that. Is this really trying to guide us to say perhaps you need a shift from the residential, or how could you make residential to ultimately yield better to cover your loan and other expenses?
So the best way to invest in residential right now is to have a low gearing. Low gearing means the proportion in your loan to your equity needs to be lower than before. So I get it. With residential, you can buy it 100% or 80% or all of that. The only way it would make sense is if the cost of your financing, it doesn't have a high bearing. It's not the one that is making your thing not work. So the best way, you need to have a deposit in, but also remember the long bond rate, you are requiring this thing to do very, very well. That's why it's very, very important for your rental to make sense before you get into that kind of property. So I would say you need to reduce the debt component, and make sure that the rental is the right rental. You're not buying at a dreamy rental. Meanwhile, it's not achievable. Reduce additional investing into that particular property, because you are not going to get a higher return than that. People go into residential because they understand it better. It doesn't mean that it's always the best option. It's also easier to get into than other sectors. Actually, we were looking yesterday, looking at the trade of industrial properties in the past year, and we only found 2 transactions. PPC that transaction happened in 2021. It's not even 2022. And then a small one in December last year, which was a small industrial workshop where somebody was just selling to somebody else at a very low price. So it's rare if you're getting into investing. It's rare for you to find opportunities anywhere outside of residential. But when you buy into residential, make sure that your gearing is right, and you don't pay more than the property is able to return you. It's a math game, honestly, at that point. So John asked about the hotel industry. The hotel industry is not doing well. I think they are at best above 4%. They're not doing well. They're not doing well at all. They had to make a lot of concessions. Even they haven't even started recovering their occupancy rates and all of that. And a lot of their leases are driven by their what is it called? Their turnover rentals. So there has to be room there as a landlord in that regard, especially when you know what's happening. So they're not doing well at all. I can't guarantee that I can't say for sure it's about 4%, but if it's returning 4%, it's doing very, very well. Even the ones at the deltas, they're also not doing as well as they did. So they don't have the same problem, property, because they rent the land, and then the structure is all temporary. But the amount that they invest on the finishings and the fittings and all of that kind of stuff they have to make a good return each year, but they're still not getting the right kind of occupancy. There is one that spent all of December that I'm aware of that had no visitors at all. So they're not doing well. Are we good? Can we continue? Okay. There's another question. Okay, cool. But hotels are funny because generally they don't do well the first 3-5 years, and then when they pick up, they really do pick up. But because they were affected by COVID, maybe they'll pick up much later in life. Now I need to go back to this one. Hotels are very funny. There's actually quite an interesting opportunity for people who own large spans of land in the Kalahari and in that's basically in the Kalahari. If you own land that is in excess of, I think they're looking for 150 hectares. There's opportunities for these guys to set up camp at your place, if you're interested. Is your hand still up? I'm assuming it's from earlier on. Okay. All right. So planning. A lot of things will happen. A lot of things will come up. Just stick to your goal. Don't add things that don't make sense. Property doesn't recover easily. When you have gotten, I remember the one time, just to give an example, there's a major client who had one residential portfolio, it had 4 units more thing, and they have a big portfolio, but they had this one asset that they had leased the entire complex to a single tenant. Individual leases, one unit, the next one, the next one, the next one. So the list that they benefit from it properly. So to restructure their portfolio, we had to terminate all of those leases and have one head lease. It's called a head lease, and have one head lease with that tenant because they had been staying in those units for over 10 years. Negotiate the lease one by one. So we did one head lease for them, and then added the levies. So they didn't have levies more thing because initially I get different tenants more thing. So a better thing the levies on it, a pool cleaner was a complex, a gardener was a complex, securities are complex, and all of that. And just from that, without changing anything major, then the property started performing. So it's very, very important to make sure that when you invest or something, invest well, where every agreement that you make sure that it fits. The things that you have to watch, I'll just share a little bit later on. The indicators you have to watch. Once you have said, I want to have a return 8%, 12%, 11% on my portfolio, don't buy anything that doesn't give you that percentage or higher. So don't say no, but it's 10.5. It then reduces your average to 10.5 or to 10 or 10.8. You are no longer at 11 and above. So you have to make sure that that thing fits your goal. You have to be patient. You have to be consistent in every day looking at deals. When you get to a point where you consider yourself to be a property investor, every day you should be looking at a new deal. Every day. So I would like when we come back the next time, let's have 2 or 3 deals that we are looking at so that we can discuss them, so that we can go just for learning that exercise. Okay, fine. This is what I have learned about this, and this is how to assess anything. Pick up more whether one more advertising and more Facebook, something that you are genuinely interested in. Let's look at it. Let's discuss it. Let's see if you can put an offer on something like that, how it can be structured so that we can learn and move forward together. The whole idea is that from there you must know how to invest going forward, and building your portfolio. Analysis, research. You have to learn as much as you can about the market you want to invest in. Like I was just showing you earlier about the different sectors and how they operate, what kind of leases they have, what kind of commitments and all. You have to know those things before you invest in a particular property, because you're already not making money. There's these ladies that we're helping with. They bought a filling station, and in their minds, they were buying the filling station and running the filling station and everything, only to find out that filling station, it's on a bar. If you run a filling station, your margins are about 20 TB from the filling station. You're not making money. You make your money from the kiosk or the depending on what you put in, whether it's a kiosk, whether it's a convenience store, or it's a bakery or whatever. That's really where you make your money. So when you assess your investment, make sure that you are assessing the right kind of things in terms of what your investment is. Now imagine if you're buying that and it doesn't have that component. Hotels make a lot of their money from the bar. So you buy a hotel, it doesn't have a bar or it doesn't have an entertainment component. You only have rooms. Your chances are then limited by all of those things. You have to invest more for. So there's all of these small things that people are not aware of or don't know about. Hotels make money from their bar, from entertainment, from casinos. So if you are going to be getting into that area, you need to know, okay, fine, what is the component that is going to make my property perform better than Zedingwe? And what is the thing that's going to bring in? Remember, as a property owner, my operator, how much am I going to be charging my operator? What are the services that I'm offering my operator? Is my operator going to be here for a long time? Are they going to be able to make money? Because if your operator is not making money, they won't pay you a rental. They will leave very quickly. Because when they haven't invested in the property, you will be left there. You need to get another operator. So those are things that you need to think about when you get into any kind of property. Do a lot of research. This is why we are here, so that we can be able to guide and assist you with that. Time. There is nothing urgent in real estate. Nothing. Everything must make sense before it becomes urgent. It doesn't matter what an agent says to you. It doesn't matter whether this deal is going or what. Just make sure that whatever it is that you're doing makes sense. Real estate doesn't. There's nothing ever. Don't ever find yourself ever under pressure to make any decision that has to do with real estate. Sleep over anything. If you found something that you like, sleep over it. Talk about it tomorrow. Let's talk about it. Come in, set an appointment. Let's discuss it. There is nothing urgent with real estate unless your house is burning down. That's the only thing that. But in terms of when you want to make an investment, you just say to people, no, I need time to think about this, put it there. Don't ever be convinced that you need to make an urgent decision because this property will go away. It's going absolutely nowhere. It can return wherever it has gone. And then success, once you get it right, once you make one good investment and it works, rinse and repeat. That's the wonderful thing about real estate, is that once you've got it right once, then you have exercised. It's such a tedious process in the very beginning. It's such an annoying process in the very beginning. But once you have it right, then it's much easier. It's your muscles now know. That's the advantage that people who have been in real estate have, is that they can look at an asset and they can see. You can walk through an asset and you can see this thing is not working. You can look at a building and say this thing is not working. You can, like, there's things that over time, because of exposure and because of the experience, you learn to see or know that this is not right from the bed. This is not making sense. This can never work this way. So you get to learn that kind of thing from that. Key indicators when you're looking for when you're looking at a project. The 1% rule is the bare minimum. It's the least. It's like the barest minimum. Experienced investors will go 2%, 3% because they want good returns, or they want very, very good returns. They want elite property. But bare minimum, before you give attention to any property, and this is why the first thing, when somebody says there's a property for sale, you must ask them what's their rental. And very quickly, it should tell you whether you should be going into it or not. 1% minimum. And 1% is simple. Whether that thing is renting, 3,000 pula ka kgwedi, motho ba go rare, o e rekisa 5 million. Immediately you should know this thing mustn't be anything above 300,000. 750,000. Remove the desperation to own from your mind, and understand that when you build wealth, you need the right bricks. You need to have the quality assets that are actually going to help you build, not the ones that immediately you are throwing away. You're literally just removing from yourself what you already have. Cost of finance, what Ona just mentioned earlier, interest rates. When interest rates are high, the only mechanism that you have is to reduce your gearing so that you can hedge the cost of finance, your own cost of finance. Normally, as you build your wealth, I know very high net worth clients would typically say their money costs more than the bank. So if you want them to put in their money in anything, that thing better give a better return than any bank's interest is requiring. So that's a great attitude to have. But when you start, just make sure that the cost of finance must be lower than the return that you have. Otherwise, you will be throwing your money inside a deep, dark hole. Costs, do your full research on the property you want to purchase before you get catfished. A lot of properties look good from the face, but when you go, do the inspection, talk to tenants, talk to neighbors, look around with an open mind, hey? And make sure that you understand fully, okay, fine. So the tenant, what happened? Like, ask questions. What happens when it rains? I don't know if you guys have seen pictures. The apartment that's at BHC, Zedimo, Tulfelo East. Can you think about the people who are on the ground floor? How much ruin that they have, barakile those units down there. That's something that a lot of people don't think about, but now your furniture is gone. And imagine if you have bought into that as an investment, your tenant is likely to leave. And now you have a scenario where every time you get worried, you need to get insurance. That's an additional cost because of that. And because now, the owners, because I get it now, it's owned by the body corporate because it's a sectional title. Then that means the owners, you need to come together and come up with a plan. That's more money out of your pocket. That's not going to increase your rental. So please understand fully what your cost is before you get into a property. Don't get excited by the idea of ownership. And then I spoke earlier about the risk-free rate. You have to make sure that the minimum return you get is equivalent to the long bond rate. And this applies even when you go and invest internationally. You need to look at the long bond rate and add a premium for the risk, tenancy, and chances of return and all of that. And in your life, never ever buy a property whose rental cannot afford its own repayments. Never. Don't think it has potential. Hey, it has what? The potential is today, is now. If it doesn't realize its potential now, it will never realize its potential. So don't go into it at all. So we've been here now for what has it been? An hour and a half. And I had said for this, has it been an hour and a half? 9, 10, 11? Yeah, 11:30, yeah. So we are halfway through. And essentially what we wanted to do with these sessions, the reason why they're 3 hours is that each hour is supposed to have a specific purpose. So we're not going to have the session here actually looking at investments because we don't have investments to look at today. But like I said, let's make sure for the next session when we come in, we do have investments that we want to discuss, that we want to look at. We have opportunities that we want to have an understanding around and discuss them. I'll also have a look at some that we are looking at and just put them here to say, okay, fine, I'm looking at this. What do you guys think? And just so that we can pick up all the different tips and tricks and things. I'm just going to share with you what we can read. I don't know if, I'm pretty sure that if you have invested in property, you have had, you've read some books. So book number 1, Basic Standard, Rich Dad, Poor Dad. We've read that. You can send a sharp reaction to say, this one, I know it, I'm good with it, I've read it, I understand it. Rich Dad, Poor Dad. Okay, that's one person. Okay, great. Okay, at least we've all read that one. Super. Great. So I read from, or rather I listen to books now because I don't have a lot of time to sit down and read. My current read is, do I have it here? No. My current read is a 4-hour work week, which is really about changing your mindset to getting to working only 4 hours a week. So that's one book, that one physical book that I'm actually reading. So you can get into that. I think it's a great book to read. It has not much to do with real estate, but more about just mindset change and getting you to think about your financial freedom in a much more serious way. But in terms of more audible, I would recommend you read Financial Freedom with Real Estate. That's a good book to look at. And then in terms, get a hella for the next time. So I was recommending Rich Dad, Poor Dad for those who have not read it, and then Financial Freedom with Real Estate. And podcasts. Let's do Inside Property Investing. It's a good one when it just dissects the things, although it's pretty American, but at least we can discuss the concepts when we come back here and how they are applicable and when they are not applicable. I'll tell you off the bat, the idea of buying property and flipping it doesn't work when the property that you are flipping is built with bricks and mortar. That is an expensive exercise. When it is built, timber and these things, it's easy to break a wall and add an extra room and add additional $50,000 into the property. But yeah, brick and mortar, for you to find a property that is significantly dilapidated enough for you to buy it at a very low price, and then for you to upscale it and sell it fairly quickly. This is the wrong time in the market to be doing that kind of thing. And also our cost of construction is much more expensive than their cost of construction. So generally the ideas around flipping property don't work for us. But anyway, in terms of podcasts, have a listen on Inside Property Investing. And then the other one that I just want us to open our minds to, because a lot of you have done your investment strategies, and I have seen that you're not looking at property outside of Botswana at all. And I think we need to open our minds because returns are good outside of Botswana, and there are many, many opportunities to invest outside of Botswana. So I would also recommend that we listen to Dubai Real Estate Unplugged. Listen to it with an open mind, and the whole idea is just to have an appreciation of what is happening in that particular market. I'll also look for one. South Africa is not doing very, very well, but we can also listen to what's happening there and different opportunities there. I can share them via an email or something on regards to that. So essentially that, aside from any questions for today, that's really where we are. The training session, Latoya?
For the South African market, there's a nice podcast. I think it's a nice podcast. If you do have Property Magicians, I think you should check it out as well. So they interview different investors in every episode, but share how they started, where they got to where they got, and because it's South African, it's very relatable.
Thank you for that, Latoya, guys. Let's listen to that. Property Magicians. Nkongi, you were asking, your hand was up?
No, I'm good.
Hey, you're fine. Hey, let's listen to that. I want us for the next session. So the way that, like I said, the way we structured it is, it's 1 hour of actual sharing of knowledge that I'm going to talk about the specific topic of the day. And then we have 1 hour of discussing what we have learned on our own. And then we'll have 1 hour of actually looking at deals that are on the table, and just discussing what deals are available. The idea is some of the deals we can be able to split them and share them here and get into them together if it's a good one for everybody to do. And then also some of the days we will have people who are experienced, people who are magnates. I've had a conversation with a few who will be happy to come and share their experience here. So some of the sessions we will have those who come and share, especially when we talk about the mistakes that you should avoid. We will have people who have made mistakes and they have learned from them, who are going to share what mistakes they have made. Otherwise, guys, pending no questions or anything, thank you so much for making at least our first class a success. Do invite others who have subscribed to come and join, so that at least as we build up, we're building each other, and we are also going to share more with the other people who have subscribed, so that we can really build a community that is targeted and focused on building wealth with each other. I know last year we had a lot of sessions on investment clubs, and a lot of people were saying, why don't we form an investment club? If we can come up together and from here we are agreeing on fundamentals of how we are going to invest, what kind of assets we're looking at, then maybe we can have a few investment clubs coming out of this community. Otherwise, thank you so much. Have a good, great weekend ahead. And I look forward to having a lot more appointments with you guys, and a lot more deals, a lot more discussions, and so that we can be able to build our wealth together. Otherwise, have a wonderful week ahead.
Thank you.
Bye.
Thank you. Bye.
Bye.
Bye.